Welcome back to Talk Tickers. Today we're digging into ZTO Express's third quarter 2025 earnings. And folks, this is a fascinating one. We've got a massive profit beat that's actually hiding a huge strategic pivot. Let's get into it. Okay, so here's the game plan. We're going to start with the headline numbers. Then we'll get into the real meat of the story, the margin pressure, and the company's big pivot. After that, we'll break down management's new quality strategy, see how the market took the news, and wrap it all up with our own rating and what to look for next.
All right, first up, the headline numbers. And at first glance, they look pretty fantastic. But you know us, we've got to look closer, because the real story is always in the details.
So the number that had everyone buzzing was this, 25%. ZTO's adjusted earnings per share absolutely crushed what the analysts were expecting. I mean, a beat of nearly 25%? That is a huge surprise, and it definitely got Wall Street's attention right out of the gate.
But, and this is a big but, here's where things get kind of weird. While the earnings per share, or EPS, was a huge beat, the revenue actually missed. Not by a lot, but still a miss. So you've got strong parcel volume growth, but the top line is a little soft. And that really sets up the central mystery of the quarter, right? How in the world do you beat so big on profit when your sales are coming in light?
So how did they do it? Well, that question leads us directly to the core narrative of this quarter, the incredible pressure on their profit margins and the strategic pivot it forced them to make. And this chart right here just lays the problem out bare. Look at this. Revenue up a solid 11%. That looks good. But then you look at gross profit, the money they actually make after the direct costs of shipping all those parcels, and it fell. It dropped by more than 11%. That is a massive, massive disconnect. And it's really the whole story of this quarter in one picture.
And what's driving that disconnect? It's this number right here, a 6.3 percentage point collapse in their gross margin year over year. That is a brutal hit. And it's all because of this vicious, industry-wide price war that's been hammering the entire logistics space in China. They're all just fighting to offer the lowest prices.
Now, what's really interesting is the timing. All this margin pressure is happening just as the Chinese government is stepping in with something called anti-involution policies. It's a key term you need to know. Basically, the government is saying, enough is enough. They're trying to stop these ruinous price wars, this race to the bottom that's killing profitability for everyone. They want more orderly, rational competition. Okay, so with regulators breathing down their neck and margins getting crushed, what's a company to do? Well, ZTO's management is essentially ripping up their old playbook and signaling a massive shift in strategy. And the CEO, Mason Lai, he couldn't have been clearer about it on the earnings call. He basically declared that the era of chasing volume at any price is officially over. From now on, the game is all about quality and, most importantly, profitability. This isn't just a big deal for ZTO, it's a huge signal for the entire industry. So how are they going to do it? Well, they laid out this 5-point plan. And if you read between the lines, it's really a shift away from just being the cheapest box mover. They're talking about better service, actually making money on that tricky last-mile delivery, being fairer to their network partners, and of course, being absolutely obsessed with cost efficiency from start to finish. But here's the catch, and it's a big one. This new strategy isn't free. There's a trade-off. ZTO is actually cutting its full-year guidance for parcel volume. They are intentionally choosing to grow slower. They're basically telling the market, look, we'd rather be more profitable than be the biggest. And that right there is the classic beat and lower scenario that can make investors so nervous. So you have this really mixed bag, right? A huge earnings beat, but also lower guidance and some scary margin numbers. So how did the market react to all this? Well, the price action tells a pretty interesting story. It was a bit of a roller coaster, honestly. Right after the announcement, the stock popped up on that great EPS number. But then, the next day, as people really started digging into the details, the lower guidance, the margin compression, the stock sold off. But then, something interesting happened. By day 2, it bounced back and actually ended up positive for the period. To me, that says the market is cautiously optimistic. They're willing to give management the benefit of the doubt on the strategic pivot, at least for now. Okay, so let's put it all together. What's our call on ZTO Express going forward? Here's the Talk Tickers rating and our investment thesis. We're slapping a market perform rating on the stock. What does that mean? Well, it's not a screaming buy, and it's not a sell either. It's what we call a show me story. Management has said the right things, now they have to prove they can do it. So here's our thinking behind that rating.
The big positive? These guys are incredible operators. The fact that they're still cutting unit costs in this environment shows some serious discipline. But the negative is just too big to ignore for now. That margin compression is severe, and the lowered guidance creates a lot of uncertainty. Ultimately, we think this quality over quantity pivot is absolutely the right long-term move. But the execution risk is real. So we're staying on the sidelines until we see some hard proof, some actual numbers that show the margins are starting to heal.
All right, before we wrap up, it's time for my favorite part, the outrageous but plausible trade idea. This is where we get a little creative.
So the idea here is a pair trade. You're basically betting on one thing to do better than another. In this case, you'd go long ZTO, meaning you're betting on it to go up, and at the same time, you'd short a broad China ETF like MCHI. The thesis is pretty simple. You believe ZTO's focus on quality and fixing its own problems will help it outperform the rest of the slowing Chinese market. I mean, look at the performance gap over the last year. ZTO has lagged the index badly. If they can successfully pull off this margin recovery, that gap could start to close in a big way. The catalyst you're watching for? Any sign of margin stabilization in the next earnings report.
And as always, we have to end with our disclaimer. Please remember, this is not financial advice.